I trust you're fine. My name is John Kehubamoya. The content that I'm going to present is common to both B.Sc, Banking and Finance, and Bachelor of Commerce, Accounting Option, Year 1, Semester 1. This is our June to September 2020 semester, and I'm going to take you through HBA 2401, Advanced Financial Reporting. This course is divided into two sections. The first part is on group financial statements, and the other part, which is subject to a different video, is accounting standards. Let's start with the introduction to consolidated financial statements. And the first thing that we need to know, even though informally, is what consolidation is. Consolidation simply means to add. And we are adding the items that we have in the financial statements of an enterprise. In this context, then, consolidation is the presentation of the results, assets, and liabilities of group of companies as if it were one company. When we talk of group of companies, even though we are going to give a more formal definition, it obviously means more than one company. But we are presenting the financial statements of one company as if they related to one company. And that's what we refer to as consolidation. I'm very sure you know quite a number of firms, large ones, that have got so many companies into them. Good examples are companies like East Africa Breweries Limited, where among others, it has companies like Kenya Breweries Limited, companies like Kenya Malting Limited, among others. Other examples would be Nation Media Group, where it has companies, it owns companies such as Nation Newspapers, NTV, the television station, the Business Daily, and all. When we put all these companies together, then we end up with what we refer to as group of companies. But how does a group arise? Group arises when one company known as a parent, or a holding company, or the central company owns most or all of the shares in other companies. And these other companies, we refer to them as subsidiaries. When we say most or all of the shares, we talk of more than 50% of the shares. And the shares that we are talking about are the ordinary shares. And the reason for ordinary shares is that holders of ordinary shares make decisions in the firm, unlike preference shareholders. The parent company usually controls, and we shall define control very shortly, the subsidiary by owning most of the shares in that company. So again, we find that this situation of group will arise if the parent or the holding or the central company has control. We'll define what control is. I repeat that again. Of the subsidiary by owning most of all the shares. But control, we notice here, it arises by owning most of the shares. But that's not the only way that ownership or control arises. There are other ways that we shall discuss in this video. From the legal point of view, the results of the group must be presented as a whole. That is, they must be consolidated. We shall define consolidation, though we mentioned it means adding up. And we are told, even without the formal definition, that consolidation is presenting the results of a group of companies as if they were those of a single company. Again, this may sound repetitive, but we said many large businesses consist of several companies controlled by one central or administrative companies. And when we put all these companies together, we end up with a group. The controlling company, which we are referring to as the central or the administrative company, is also known as the holding company, and generally will own some, well, not just some, but most, all of the shares in the other companies, which we've already mentioned are known as subsidiary. But what does consolidation involve? Consolidation basically means adding together. We mentioned that. And in adding together, we cancel those items which we refer to as intra-group items. Those items that are similar. We shall discuss them in this course. And you consolidate as if you own everything. Then you show the extent to which you don't own everything. And the extent that you don't own everything is referred to as the minority interest or the non-controlling interests. But why do businesses operate as a group or as groups? One of the reasons for that is because of the names associated, the goodwill associated with those names. And then it will be for tax or for legal purposes. And in most cases, it's for legal purposes because in most countries, including our own, the Company Act requires that the results of the group should be presented as a whole. Now, even though we are saying we add, it's not always possible to simply add all the results together. And in this topic, and in others that will follow, we shall learn how to consolidate all the results of companies within a group. Again, we insist that in traditional accounting terminology, a group of companies will basically constitute of a parent company and one or more subsidiary companies. The subsidiary need not be one. The company which is being controlled really does not have to be one, they could be several. Like the example of the Nation Media Group that I gave. We have Nation Newspapers, we've got NTV, we've got NTV Radio, Business Daily, Taifa Leo, and all that. Now, in preparing consolidated financial statement, there are 5 accounting standards that we shall pay key attention to. The first 2 are the International Financial Reporting Standards 3, Business Combinations, and International Financial Reporting Standards 10, Consolidated Financial Statements. As we shall see, even though these 2 talks of different components of preparation of group account, there are some overlaps, but we'll mention them. Then we've got IFRS 13, fair value measurement. We've got IAS 28, investment in associates and joint ventures. I've put an asterisk next to joint ventures because in this course, joint ventures is not part of what we are required to look at. And then we've got IAS 27, separate financial statements. Those 5 different accounting standards will take us through. The 2 international accounting standards, International Accounting Standards 28 and 27, and the 3 International Financial Standards, IFRS 3, IFRS 10, and IFRS 13. Like I mentioned, though each of these standards will be concerned with different aspects of group account, we'll find there will be some overlaps between them, particularly in IFRS 3 and IFRS 10. Let's look at some formal definitions that we've already mentioned. What is control? Now, the definition that we have here has got some legal context into it. But when we talk of control, we are talking of an investor. An investor here will be parent company that controls an investee when the investee is a subsidiary, when the investor is exposed or has rights to variable returns from its involvement with the investee and has ability to affect those returns through power over the investee. And that's the definition as given by IFRS 10. The definition may be a little bit technical or legalist in writing, but don't worry, we shall simplify it very shortly. Then power. Power exists. Power means existing right that gives the parent ability to direct the relevant activities of the investee, where the parent or a company has ability to direct certain activities, and these certain activities will be administrative and financial, then we could say this power. Then subsidiary, we said it's an entity controlled by another entity. Of course, the other entity is the parent. And parent, we define it as an entity that controls one or more subsidiary. And then we have group, a parent, and all its subsidiaries. Then the other definition is an associate. And before we move to the associate, I'll move a little bit back. We defined a subsidiary as an entity that is controlled by another entity. And then we defined parent as an entity that controls one or more of the subsidiaries. And if we go way back, we had said that control would arise when the parent holds at least 50% of the shares. We had said that, all right? When the parent holds at least 50% of the shares. Here, where the controlling company called the parent or the holding company will own some or all of the shares in other companies called subsidiaries. Now, when we talk of some or all, it obviously means there are some which are not owned by the parent. What is not owned by the parent is known as minority interests, or with the most recent term, non-controlling interests. So we are saying, we were defining an associate. We said an associate is an entity over which an investor has significant influence and which is neither a subsidiary nor an interest in joint venture. We shall see shortly that when we talk of an associate, you're talking of a company which is holding between 20 and 50% of the ordinary share capital. Though there are some other qualification for that, let's hold on to that definition for now. What is significant influence? This is power to participate in the financial and operating policies. Very important. Financial and operating policies. And perhaps at this point, I should mention about Safaricom. We all know who the current CEO of Safaricom is. We also know that the Kenya government owns about 35% of the shares, but it was able to determine who becomes the CEO, or it had its way. It had said the CEO had to have to be a Kenyan, and that's in a company that it has got it doesn't own because it owns less than 50%. Why it was able to determine that is because it has significant influence. And significant influence arises when the company or the parent or the investor has power to participate in financial and operating policies. Of course, the CEO of an enterprise is an operating entity uh, in the financial and operating policy decision of an investee is subsidiary, but it is not in control or in joint control. Let's summarize the different types of investment and the required accounting for them. The first one is subsidiary. How do we know, what criteria do we use in order to determine whether there is a subsidiary? The criteria that we use is control, and this control if the parents own more than 50%. What's the accounting treatment? The accounting treatment is full consolidation. Then an associate that we've just spoken about. The criteria for determining is if the significant influence. And we have significant influence if the parent or if the investor holds between 20% and 50% of the shares. And the accounting treatment is equity accounting. Now, this is what you learned in lower levels. So you're not going to do equity accounting. And finally, investments, which is obviously none of those, and it will mean less than 20%, or assets which are held for creation of wealth. And the accounting treatment is to treat as if they are a single company account. Again, this is not in our current syllabus, neither is associate, but subsidiary and full consolidation is. From those definitions that we've given, it's important to point that control exists if the holding company or the parent owns a majority, very important, of the ordinary shares. I said they must be ordinary shares in the subsidiary. And the items in parentheses, we are simply emphasizing their ordinary shares because it's in ordinary shares where we have voting rights. We may have situations where even though the parent owns a minority of the voting power of the subsidiary, but it still has control. IFRS 10 provides three separate elements of control. And we are saying an investor has control over a subsidiary if and only if. If and only if means the entire criteria has to be met. And we say the criteria is that there are three separate elements. If and only if A, power over the investee, we've defined power, exposure to or rights to variable returns from its involvement with the investee. Variable returns are returns from ordinary share capital. And the third one, the ability to use its power over the investee to affect amount of the investor's return. Sounds technical, but let's summarize it. We can summarize those three scenarios as follows. We shall have control if the parent has power over more than 50% of the voting right by virtue of agreement with other companies. We are looking at a situation where the parent owns less than 50% but still has control. The parent has power to govern financial and operating policies of the entity, either through a statute or by an agreement. The parent has power to appoint or remove a majority of board of directors members. D, the parent has power to cast a majority of votes at meeting of the board of directors. When any of those is fulfilled, now here is any, then there is assumed to be control. Let's talk about investment, even though we mentioned them. Now, when we talk of an investment, we are talking of a situation where the total holding is then less than 50% and more than 20%. It's actually more than a simple investment. However, there are some criteria, and amongst them, a significant influence. And significant influence is defined as the power to participate, but not to control. Significant influence is power to participate, but not control. Of course, if this control would end up with if this control would end up with a subsidiary. Now, we determine significant influence by the number of shares held. According to International Accounting Standards 28, if the number of shares held is 20% or more of the voting power, then we assume the significant influence over the subsidiary, unless it can be clearly shown that is not the case. However, we can assume significant influence not to exist if the investor holds less than 20% of the voting power of the subsidiary, unless you demonstrate otherwise. So in either cases, whether it's presumed that significant influence don't exist, we have the first threshold, and then we've got the alternative, unless it can be proved otherwise. Now, how do we determine whether there is significant influence? The first one is through representation on the board of directors. 2, participation in policy making process. C, material transaction between the parent and the subsidiary. D, interchange or transfer of management personnel. E, provision of essential technical information. And like we had said earlier, IAS 28 requires that we use equity method where you have investment in associates. However, in our class, we do not have a situation of we'll be looking at equity method of accounting. That brings us to the end of this video, and we shall stop at that point. The next video we shall look at the consolidation criteria. My suggestion is that after you watch this video, you subscribe so that when more comes, you are able to note them. Thank you.